All right. Well, hello, everyone. Welcome to Exencial's 2023 Market Outlook Call. My name is Courtney. I'm an investment analyst here on the investment team, and I will be moderating the call today. We're going to plan on having a 30-minute discussion on market topics, and then plan on using the last 30 minutes just for some Q&A. One quick housekeeping note: you can submit your questions inside of the Zoom screen using the Q&A tab on your screen. So please make sure you submit any questions that you have. And then at the end of the call, I will relay those to the rest of the group. And we will just keep these compliance and disclosure slides up for a minute or so, and then do some quick introductions and get started here. All right. Well, we'll be hearing from 4 members of the investment team today. Speaking first will be Tim Courtney, Exencial's Chief Investment Officer. Next, we'll hear from Pete Trontis, who is a Senior Portfolio Manager for Exencial's Equity Strategies. Following Pete, we'll have Jeff Hibbeler, Senior Portfolio Manager for the Fixed Income Strategy. And we will wrap up our discussion with Jon Burckett, who is Senior Portfolio Manager for the Options Strategies. So with that, let's go ahead and begin.
Thank you, Ben. Okay, so my piece we'll do a real quick look back at maybe where we ended the year at 2022, and then where we stand and what we think we're looking at moving into 2023. If we look at some broad economic dashboard numbers currently, few takeaways from this graphic. One, you'll notice that the yield spread currently is negative. So the difference between longer term bonds and shorter term bonds right now is negative. That's the market's way of saying that the market thinks that weakness is coming, and it's a potential harbinger of a recession. It's not always the case, but historically, when you see the yield spread be negative, where the yield curve is inverted, that is a sign that the market is thinking that we're headed for weakness ahead. Couple other, good pieces of information, though, on this graphic is you will see home prices, which were at the top, the far right end of this chart at around 21% price increases about a year ago. Now we're seeing home prices down. They're still growing on average around 8%, but that's within a typical range. It's coming down. That's one of the major areas that the Federal Reserve had targeted bringing those price, really a main driver of inflation. They wanted to bring that down. Those have been falling in some areas. You start to see home prices actually fall and go negative in certain metro areas. But one thing to keep in mind, the last true recession we had in 07, 08, 09 was really real estate driven. We don't have the kind of real estate overhang that we had in that market. And so while you have seen some areas have negative home prices, in most areas you're seeing still some growth, albeit more in a typical range and not the high end that we saw last year. So that's a good, I think, good news for the markets. The other piece is unemployment still is quite low. Hiring, while we've seen a lot of headline labor force reductions in a lot of large companies, it still appears as though the unemployment number remains low. If, however, that is more of a concurrent lagging indicator. If we start to see some weakness, we'd expect that unemployment number to start going up. It has not so far. Okay. If we look at where the markets landed at the end of the year, last year, just looking at the broad equity markets, the United States had an okay fourth quarter. In the US, the equity market has about a $42 trillion total market. It's a little bit less than 60% of the global market cap. Developed International had a very good quarter. It was up almost 20% for the quarter. And so it makes up about 30% of the world's market cap. And then emerging markets was up maybe about 12 to 13%, maybe a little bit less than that. And emerging now is making up a little more than 10% of the global market cap. If we look at where the, say, broad asset classes within the equity market, where they lie today in terms of their valuations, and their valuations relative to where they've been over the last couple of decades. If we look over there at the right-hand side of that slide, we'll see large growth, large blend, large value, U.S. mid small caps, international developed, international small and emerging markets. As you go from top to bottom there, the U.S. large growth space is really probably one of the areas with the best quality of companies, the best growth, the most consistent profit growth, sales growth. These are higher quality companies. As you move down the list, you move into some companies that may have some issues. And as you go down the list more and more, you find companies that are more exposed to recession risk, to economic risks. They follow more of the economic cycle. And as things weaken, these companies tend to react worse to that news. And so they're more sensitive to the downturns. When we look at the valuation of those companies, going from top to bottom, going from what you might say are the highest quality companies down to maybe some of the lowest quality companies, you can see that the market is pricing those companies maybe as you would expect us going into a year of uncertainty and a year in which a lot of people are talking about a recession. The large growth companies, the highest quality companies maybe in the market, are trading at a premium, about a 15% premium to their long-term PE valuation average, which means the market is willing to pay up for that quality. They're willing to pay more for companies that are more consistent and should be able to weather an economic storm better. As you go down that list, you see that markets are pricing those asset classes either close to their average or in discounts. And the market is doing that because it sees the weakness coming and is already in advance discounting the valuations of those companies, expecting that probably earnings will weaken and these companies will go through some troubled quarters as economic activity slows down. Okay. One thing that the market is certainly looking at, and I know Pete will touch on this more fully in just a few moments, is what the earnings will come in at for 2023. In 21, we had a huge growth, huge jump in earnings. We went above $200 for the full year in 2021. That was spurred by really low interest rates and a lot of stimulus. It's not unusual for earnings to come down from a number that was influenced so much by those stimulative policies in 2021. In 2022, it looks like we're going to come in on the S&P 500 operating earnings around $200, maybe a little bit less than $200 a share. The expectations for 23 is for S&P earnings to be at around $220 to $225. That's probably a little bit high. But if we look at the trend number, even if earnings come in around where they were last year in 22, maybe even a little bit less, you would still say that the earnings numbers are coming in relatively good compared to the trend, and markets would probably applaud if we were to come in and repeat the earnings that we had in 2022, if we were to repeat that this year. And that would put the S&P valuation at about 20 times earnings, maybe a little bit less or a little bit more. That's about what the S&P has traded at for the most part over the last 2 decades, so it wouldn't be too far off of its long-term average. Okay. And I'm going to wrap up my portion by just saying in 2022, really, I think that was a year of resetting and rebalancing. Because of the zero rates and because of a lot of the stimulative policies at the government and at the central bank level, a lot of things got distorted in 2020 and 21. And last year was partly the market's way of saying it needed to correct and rebalance. You're seeing that happen as capital and as labor are moving out of certain areas of the market, and it's moving into other areas of the market. That was, I think, a healthy rebalancing. Also, something that stopped or reversed in 2022 was the idea of TINA. There is no alternative to stocks. That was the rule for much of the last decade, as interest rates are very low. But now that you can go earn 4.5%, 5% on bonds, that is a viable alternative to stocks. And so right now, there is no alternative, is on pause. There are viable alternatives to go out and get relatively good yields. And so that's going to keep stock valuations honest. And again, that's a good thing for a healthy market. Broad market valuations were pulled closer to their longer term averages last year. And the dollar, which had gone on a huge growth spurt, finally faded and started to fall back down closer to its trend line in the fourth quarter, allowing international markets to actually outperform US markets for the year. And that's continued into this year. When we look at this year's expectations, as we mentioned, the valuations and in the inverted yield curve are implying a minor recession. Most observers are calling for a recession to occur this year. We expect inflation to continue while it is declining and falling back closer to its single-digit long-term average over the last 100 years. But we don't think it will be easy to get that back down to the Fed's 2% target. There are too many other things happening in the market, in the labor market, with the supply chains that we think that will keep that elevated above that 2% target. And for that reason, we may see that the Fed may not wait for inflation to get down to a 2% level before beginning a reversal. In fact, the market is starting to price in some expectations of some future rate cuts in 23. But we do think that volatility will remain elevated, not like the standard deviations of, say, 10 to 15 that we saw for many years before 2020. A couple of considerations that we think are important to keep in mind. As we have this business cycle that's been truncated into about a 2 to 3 year span, we think it's important to remain diversified across asset classes in the US and international. Use fixed income for liquidity and a volatility dampener, as if interest rates do start to fall because of weakness, bonds should do relatively well. Expected returns are still positive, but we probably won't have a repeat of the last decade of returns, which was very high relative to historical averages. Again, it was helped higher by very low rates, low inflation. and just refrain from making large asset allocation changes unless something in your personal circumstances have changed that warrant such a change. At times when markets are moving and you could have a large move in markets, you don't want to make a large asset allocation change and potentially expose yourself to timing risk. So those are the ends of my slides. And now I think we will go to Pete for his view on equity markets.
Sure. Thanks, Tim. It's going to sound a little bit of a echo to what Tim said, but I'll take a couple key points that he mentioned and kind of dive a little bit deeper. So we're going to start with what happened in 2022. In that exercise, I think it's beneficial, at least to me and probably to you guys, is to kind of break down, what actually was what came down versus something else in relative terms. And what I mean is, if you take the price as a function of market sentiment, so what the market perceives as risk, and EPS growth, you will take that function, you will derive to what the current market price is, right? So it's price times or EPS growth times PE. So what we saw in 2022 is that the EPS growth was there. It wasn't really the higher inflation and just the general higher rates did not necessarily impede EPS growth across most of the sectors. Most of the companies were able to in a way increase the price of their whatever they were selling, and they were able to keep the costs down, mostly because what we saw was a cost inflation versus a services inflation. So with the supply chains being down and just the general bullwhip effect that we saw with COVID, companies were able to increase what the selling price, but they were able to keep the wages down and just the general operating expenses. So if you see in the graph or in the chart, you can see that most of the sectors saw a massive adjustment into the PE or the market perception of risk, but at least some of the bigger sectors actually did not see that much of a decline in EPS. So to me, says that 2022 was a year of inflation and a year of higher rates, and the market adjusted to that. But it doesn't necessarily mean that the companies and the economy has adjusted to that. And that would probably be the theme for 2023. So if you go to the next slide, just a quick note, this slide or this chart was taken on Friday. So if things have changed dramatically on Monday or today, this doesn't reflect that. But I think the message stays the same. The current market expectation is that from last year, next year, 2023 is going to see a growth in EPS of 9%. Which, if you do the math, it equals a PE of 17. The note on this, we can discuss if this is feasible or not, but some of it has to do with the mechanics of how analysts work. They're not super quick to adjust downwards when it comes to earnings, right? And some of them actually are waiting for the management teams to come out during the earnings calls and say, like, by the way, 2023 is going to be lower than 2022. And then analysts go ahead and adjust downwards their expectations. We are at the beginning of earnings season, so we have seen some companies do indeed come in and say, hey, by the way, our earnings are going to be lower. But the analysts are not going to do that ahead of time. They're not, in a way, they're not paid to be heroes. They just follow the herd. So they will just adjust when it's time for them to adjust, which may be a little bit too late. But hypothetically speaking, if we'd grow EPS at 9% and somehow we escape the economic downturn, that would mean that we have achieved what the Fed calls a soft landing, right? So they were able to bring inflation down enough. We don't expect to be 2%, but we don't expect it to be 8% either, without actually derailing the economy and without actually seeing a massive wave of layoffs coming our way. I'm not sure that it would be the case. Currently, there's two camps of thoughts, right? You have the soft landing camp that expects that this is going to happen. This is going to be a mission accomplished, and they're looking at the cost inflation coming down, which it is. Like most of the goods that we have seen out there is actually experiencing a price decrease. And they're following the natural path, saying like, hey, by the way, if cost inflation continues to go down, then the Fed is going to be less aggressive with their hiking schedule. They're going to take a break. They're going to see what's going on. And maybe by the end of 2023, they're actually going to ease a little bit just to help the economy along. So if that were to happen, then equity markets will behave nicely. I don't expect a lot of volatility because it's just smooth sailing from now on. I think you can switch the slide. I think in 2023, we are going to, if the story of 2022 was inflation and the fact that it's going to lead to a quantitative tightening, I think 2023 is going to be the year of digestion. So we have increased from 0 rates of the Fed fund to 4%, and the terminal rate is close to 5%. So we have the economy somehow, through all the different sectors and all the different subsectors and different businesses, have to digest a reality that rates were not 0 anymore. They are 5%. And how do we deal with that? So if somebody was getting financing at 0, now they have to get financing at 5%. And that by default makes less attractive any sort of like extending your business activity or your capex and so on and so forth, right? So we the issue that we are seeing is that while cost inflation is coming down, cost inflation was so high and for such a long period in 2021 and 2022 that actually this has bled into services inflation, right? So which is pretty much wage growth. So people were seeing that we're going to the grocery store and then noticed that, hey, by the way, my normal grocery bill is 10% higher. And they went to the employer and said like, hey, I need to get an adjustment for this. So this started at the part-time employees, and then they went to full-time employees, and then it went from lower rank employees to higher rank employees. So we're seeing an actual wage growth that is, statistically speaking, very much correlated to services inflation. So when wage growth goes up, services inflation goes up. And that is what the Fed is trying to bring down. It's trying to contain wage growth so the services inflation actually comes down with the cost goods inflation. So, and that is much harder to achieve unless you actually start laying off people, because once your employer gives you a 5% raise or 10% raise, they can go ahead and adjust downwards and say, by the way, I'm going to reduce that raise in the next 3 months or the next 6 months, right? The only way to do so is to either hire at a lower range or actually let people off so you can adjust your cost structure downwards. So while this is happening, we expect that there's going to be a moment of weakness in the economy, and to the extent there may be a moment of weakness in the market. So in that scenario, we actually like to play with probabilities and make educated guesses of how things could play out, and that's what we are showing in the slide. So hypothetically, if you have a Goldilocks scenario, perfect landing. Fed is restrictive enough, but not too restrictive. We can see the market rise and go to 4,500. That is the best case scenario, right? The base case that we kind of operate under is that we are going to see some EPS adjustment downwards in the EPS growth. I don't think the 9%, as Tim mentioned, may be a little bit too aggressive. And given that the market sentiment was very, very low to begin with, I don't expect that the PE, what actually indicates market sentiment, will go much lower. I think it's going to stay where it is. So I think our base case scenario is that the market has a lot of volatility, it goes up and down, but it kind of stays in the level that we are right now. I don't, it seems that given historical numbers, that seems to be the best, the base case scenario, or the most probable scenario. And of course, you have the scenario where the Fed overdoes it. It doesn't stick to the perfect landing. It gets too restrictive, and then all of a sudden EPS growth goes to 200. And because of the perceived risk of the Fed messing up, the P's move down, and you have a 32 range for the S&P. If you were to take a weighted probability on those scenarios, you get close to 38, where we are right now. So I think that's the expected rate for us, or the expected return. We think that there's going to be opportunities to buy into to sell into a rising market and to buy into lower market. But overall, at the end of the year, our base case scenario is that we're not much higher and we're not much lower. We're around those levels. So in conclusion, last year was the year of inflation. This year for us, we call it the year of digestion. We need to digest whatever has happened over the past year and a half, and that, we don't know necessarily how that will be reflected into the economy. So we will be vigilant and see what the future brings. I can open up to fixed income now.
All right, thanks, Pete. Appreciate that. Yeah, so in fixed income, 2022 was a historic year for bond markets, and really that's just kind of a polite way of saying that it was the worst year in bond markets in a very long time. Some people have said that maybe it was the worst year in 100 years. Looking at bond market composition, it's changed a lot over the decades, and that makes some comparisons difficult. But really, kind of in its modern form since the 1970s, it certainly was its worst year. And as we know, and as Tim pointed out earlier, yields moved much higher, driven by the most aggressive Fed tightening cycle and campaign since the 80s to pull down lower inflation. But also, as importantly, it was to keep future inflation expectations from becoming unanchored. So throughout the year, the Fed became progressively more hawkish and hiked their short-term funds rate by 4.25%, which pushed yields higher across the yield curve. And Ben, if you wouldn't mind flipping to the first slide, this shows the change in yields over the course of 2022. The green line, beginning of year, the blue line, end of year. The bottom shows the magnitude, and it's kind of truncated, but essentially yields rose between 200 and over 450 basis points, depending on the point of the yield curve. So very dramatic moves. And as Tim mentioned, the yield curve did invert, with shorter maturity yields rising higher than long-term by the end of the year, which was also the most, again, since the 1980s. And the Fed wasn't alone in this. Most global central banks did aggressively tighten policy in 2022, although the Fed was one of the most aggressive in doing it. And one stat that was we've read a lot about. It was negative yielding debt. And I think at the peak, it was over $18 trillion. Now it's at or near zero. So certainly large adjustments throughout the global bond market. Finally, corporate credit spreads, something we look at a lot. Did move somewhat higher in 2022. But I would say that compared to the volatility and moves in yields, their widening was more muted than what I would have expected throughout the year. And I think, the strong corporate revenue growth, Pete talked about this some, and overall pretty solid fundamentals were supportive of the corporate sector. So looking ahead at 2023, similar actually to 2022, we expect Fed policy to be the main driver of yields this year. But instead of an increasingly aggressive hiking and policy stance, I think the focus is going to be more on when will the Fed pause hikes, for how long are they going to hold them steady at a restrictive level, and then finally the possibility of rate cuts, or the other possibility that's not talked about a lot is, they could even possibly resume hikes if the inflation in the economy doesn't play out the way they expect. So it currently is still all about inflation, which does look to have peaked, but it's still at much too high of a level. And as the chart shows, the green line is the Fed's preferred measure of inflation, which is PCE, personal consumption expenditures inflation. And we see that it peaked somewhere around 7%. Right now it's around 5.5%. Friday, we actually get the next release, and estimates are to around 5. So inflecting down. The blue line is the federal Fed funds rate, which is close to 4.5. When the Fed meets here in next week, they'll likely move it another 25. So one of the questions is we're looking is where does policy need to go for the Fed, and what is sufficiently restrictive? One commonly cited metric is that Fed funds is above the inflation rate. So it looks like we're likely getting close to that. We're not quite there yet. But as Pete mentioned, there's a lot of tightening in the pipeline yet that hasn't really started to hit the broader economy. So with this tightening cycle, part of what the Fed is doing with their aggressive moves, they're trying to rebuild credibility. And by doing that, we think that they're going to likely be at their terminal peak rate for longer than what is typical and what is expected, as they don't want inflation to flare back up. And the longer that the job market holds in, that's actually easier for them to do. Currently, they're surpassing their employment mandate, and really they're not needing to balance risks on both of their mandates. They're missing their inflation mandate quite a bit, and more than meeting their employment mandate. So right now, I would categorize it as an easy decision for them. Looking at the economy, as we've discussed, kind of consensus is slowdown later in this year or earlier next year. That's the point where the Fed will need to start balancing the risks more in their mandates. And in fixed income, we believe at that point and leading up to it, that will be more supportive of longer dated yields as it becomes more apparent that the economy is slowing down. The other aspect of that is that there is potential for corporate spread widening as the market tries more prices in more credit risk into that market. So with that backdrop, overall in fixed income, we're finding market yields relatively attractive. Broadly in investment grade, for our strategy, yields are near the highest they've been in the last 15 years, really since the financial crisis. Looking in the near term, we think shorter maturity yields have some more upside risk than longer, due to the kind of the not necessarily mispricing, but the market pricing is a bit at odds with the Fed right now. So we do see some potential for some upside in shorter maturity yields, more so than longer. But as the year moves on, if recession risks weigh on yields, if the Fed stands their ground and we don't see what some have termed an immaculate disinflation, then we could see some downside in longer yields. Overall, we kind of feel that the yield component will be the main driver of returns for the year, but could see some modest price appreciation potential. Also heading into the environment, we're focused on managing risks in both volatile overall trading environment, but also a tightening monetary policy environment. It's giving us in our construction defensive positioning, having added to the government allocation in our strategies, and also looking adding to more defensive sectors and names. So this is all in the context with our philosophy is that fixed income is the ballast in a balanced portfolio, wanting to provide stability and income generation. So I'll wrap my fixed income comments up and I'll turn it to Jon.
Thanks, Jeff. Ben, if you could advance the slide for me, please. So Pete touched on the sort of Goldilocks soft landing scenario versus the recessionary scenario. My sense is that we're sort of in a foot race here between inflation and recession. So, as Jeff highlighted, the quicker inflation comes back to earth and gets back into a normal range, the sooner the Fed can back off and take rates out of restrictive territory, and that will allow that recovery to continue off the COVID lows. It's important to note that the lines on the graph are not projections. They're best thought of as probabilities, right? So we have some probability of the soft landing path and some probability of the the red recessionary outcome, and the market is trying to balance and weigh those probabilities in real time. Next slide, please. Some factors that I wanted to touch on that have been impacting the markets over the last couple of years. One of the big ones is the flows in and out of stocks and bonds. So in many ways, those are a contrarian indicator. When people are buying a lot of stocks, as they did in 2020 through all the way through 22, that tends to lead to a short, sharp surge, but it can be a bit of a headwind for longer term returns. And my sense is that we have not seen a capitulation event of the type that has marked the end of many prior bear markets. We don't always get a nice, wrapped up in a bow sign that things are over and the coast is clear. So there's no guarantee that we'll get that. But my sense is that there's still a bit of speculative zeal in the markets. And as an example of that, Bitcoin is already up, I believe, about 40% now in January. So I think that is going to contribute to the elevated volatility environment that Tim touched on, is that underlying speculative fervor, I don't think has been squashed yet. The second thing that's really changed over the last year is the narrative on inflation. We went from the Fed and pretty much everyone else dismissing it as transitory. I made this mistake myself, quite frankly. And then we started to get news headlines about 1970 style hyperinflation, and there was a big scare. And now the market is right back to pricing it as if it's transitory after all. So we can look at market pricing via inflation swaps, via break-evens, and other ways. And the market is right now pricing in a very sharp decline in inflation back towards the Fed's target. And if we get that, it would be lovely. But if instead we see inflation stick at a level of, let's say, 4.5%, where it is, it's certainly off the boil, but still uncomfortably higher than the Fed's goal, that's going to be a bit of a problem for the Fed. So I believe that stocks this time around are going to have to stand on their own 2 feet, i.e. earnings, and not rely on monetary stimulus. In our investment team meeting today, we talked about the fact that in the last decade, we've had this lovely scenario where you had strong earnings growth and low inflation, which allowed central banks to pump a lot of stimulus out. And that's simply not going to be the case this time around. That combination of strong earnings and low interest rates are unlikely to happen both in conjunction this time around. The second big point I want to make on this slide here is that a recession is not this process where you can track it and chart it and make a point estimate of when it will start to emerge. It's really a sudden breakdown. You never know when the final straw is going to break the camel's back. It could happen tomorrow, it could happen in Q4, or it could not happen at all. So really, again, the focus should be on probabilities and expected returns, not on trying to make all or nothing bets. Again, as Tim highlighted, the Fed is saying that they're going to stick over 5% on rates all year. Well, the market's already pricing in rate cuts beginning in July. So significant amount of optimism is beginning to emerge. But we could still be several quarters away from the onset of recession. It feels like we've been talking about it for a significant amount of time. The yield curve first inverted early last year, and that is a classic early warning signal of recession. A lot of the soft data, CEOs surveys, purchasing manager surveys, and the yield curve, they're all pointing to elevated probability of a recession within the next year. Whereas the hard data like employment remain quite firm for now. So whether the hard data catch down to those leading indicators or whether the leading indicators inflect and start bouncing back, we don't yet know. And if we wait for the official declaration of a recession, we'll be way late in trading, because usually the market has already bottomed and started bouncing significantly by the time we actually get the official word that a recession has started. So that's not really a useful indicator. Next slide, please. We have seen a pretty strong recovery off of the October lows. And there are reasons for optimism. So we're likely near the peak of this Fed hiking cycle. The US dollar may have peaked for this cycle, and that's supportive of economic growth in the rest of the world. We've seen volatility start to moderate in fixed income and currencies as a result of that peak in the Fed cycle and the US dollar. We've seen China make a sudden about face on their COVID-0 policy and start to reopen. We've gotten lucky with warm winter weather in the EU, which has allowed them to sidestep their predicted energy crisis, at least for now. So overall, market breadth, momentum, and sentiment are becoming much more neutral or positive than they have been in the last year. Credit spreads in particular are relatively tight. So there's very little indication of near-term financial distress. And again, I emphasize that is for now. So my sense, and this is also based on pricing in the option markets, in the near term, the most likely path is sort of a slow grind higher. Now, I think we've been very spoiled based on the last couple of bouts of volatility in late 2018 and again in early 2020. We've had these very rapid V-shaped recoveries. And again, I want to emphasize that what enabled those was the Fed's ability to pump out stimulus in response to market distress. And this time around, their hands are tied by that persistent inflation. So we're just not going to get back to 2% on rates while earnings are great at the same time. Those two things aren't going to happen at once. So we're either going to get a continued earnings growth and a nice recovery, but with higher rates, or we're going to get a recession and rate cuts, but not both at the same time. In the very near term, it seems unlikely that we're going to retest the lows as long as the inflation outlook continues to improve and earnings hang in there. We're in the thick of earnings season right now. We have some important companies such as Microsoft reporting after the close today, and that'll give us a good read. Again, the bottom-up fundamental analysts, as Pete pointed out, have remained quite optimistic and reluctant to cut their outlook. On the other hand, the top-down economists and bank strategists have been very pessimistic for over a year now. And as a result, my sense is that it's likely in Q1 that we're going to come in somewhere in between those pessimistic and optimistic views. And that should allow the recovery in the market to continue. And again, maybe through the spring. We do have some potential negative catalysts later on in the year. Obviously, Jeff mentioned that there's a lot of tightening that is already in the pipeline, and it takes time for that to flow through the system and actually hit the economy. So right now, it doesn't look as if that's going to hit until later in the year, but again, it's impossible to nail the timing on that exactly. The commodity prices were a significant factor in the inflation issues that we had post-COVID. And as China reopens, and we have to keep an eye on commodity prices. If oil reaccelerates, if wage growth reaccelerates, if consumer spending reaccelerates, any of those things are going to take the air out of this inflation optimism and bring us right back into a situation where the Fed pivot is off the table again. I have on here the debt ceiling and a potential U.S. default on its debt. I have to emphasize this is an extremely low probability event, but it would be a high impact event. And the timeline for some sort of resolution on the debt ceiling is late summer, early fall. In terms of positive catalysts, we've got obviously the ongoing war in Ukraine. It doesn't seem likely that will be resolved, but you never know. One of the dynamics that's led to many of the big rallies over the last year has been the persistent bearishness on the side of professional investors. And if we do get a grind higher, it may be hard for those folks to maintain their bearish conviction and sit on their hands and just lose money as the market grinds higher. So my sense is that there's a risk that people could get sucked into chasing the market higher only to have the rug pulled if we get a recession later in the year. So that's something to be aware of. And then obviously the soft landing, that the fall in inflation is genuinely good news. The resilience of the labor market and consumer spending is genuinely good news, and we shouldn't discount it. So there is a pretty decent, and rising probability of a soft landing here. So I don't want to dismiss that out of hand. Next slide, please. I do expect the year to continue to be volatile. You can see in blue there on the top panel, that is the VIX. It's a measure of equity market volatility. We are still above the sort of low volatility environment that we were in from about 2012 through 2020. We're still at a higher baseline level, but we are well off of the highs, and we're nowhere near the sort of crisis levels that we would have seen during COVID or during the financial crisis back in 2008, 2009. So elevated volatility, but not crisis levels. The orange line is a similar indicator, but for the US Treasury market. And you can see volatility there was fairly muted until the Fed pivoted and started aggressively hiking rates. Volatility spiked in the fixed income markets, and that is now starting to decline. And I expect that to be a positive for the equity market as well. One note of caution coming from the option market is the low level of skew. And there are different ways to measure this, but the demand for downside put protection versus the cost of at the money or upside speculative calls, it can kind of give you a sense of investor complacency or demand for or fear, frankly. And right now it's at relatively low levels. There does not seem to be a lot of demand for crash protection. And that says to me that market participants are still expecting that the central bank will ride to the rescue if markets get into distress. And I think that is likely to happen. That Fed put that we've talked about for years is still in place. My worry is that the strike price of that Fed put, the level where markets could fall before the Fed would step back in, may be lower than in prior years, again, because of that inflation dynamic. And that is it for me. Pete and Ben, I will hand it back to you.
All right. Thank you guys for that market discussion. Now I think we can transition to some questions that we've received. And so I'll go ahead and just jump right in with that. And the first question that we've gotten, and this can, I think, go to anyone if anyone wants to take this first one, but question is, how and to what extent does the increasingly unstable global climate figure in your outlook? Not just the coming 12 months, but especially over the coming 5 to 10 years.
I'll take that, and then maybe somebody else can jump on to add to that. So I think the question was talking about the growing instability globally. We've seen that in supply chain problems in countries that were shutting down. We saw that led to inflation. We are seeing companies that are attempting to avoid a repeat of that mistake by reshoring, by moving production and facilities back closer to the United States, if not in the United States, then either maybe in Mexico or Canada, to have a better control over that. I think, as maybe the world pulls back a little bit from globalization, probably the primary outcome from that is a higher level of inflation. And we've gotten used to, over the last decade and a half, of inflation being, say, 1.5% to 2%, very low. If we continue to have problems with global supply chains and global integration, I would guess the outcome would be higher inflation, and therefore, you'd have higher interest rates. And going back to what we said a couple of times, probably not the huge kind of V-shaped recovery that we would have had in the past, where rates fall rapidly, inflation falls rapidly, and then you get a higher valuations on all the assets. That probably, I think, would not happen as global stress either stays the same or increases.
All right. If no one else wants to jump in on that one, we'll move on to the next one. This might be a good question for Pete. Another question that we got are there any sectors you like or dislike more than others?
Yeah, that's a good question. I guess it depends on how the year progresses. Currently, I think we are finding that due to the 2022 drawdown, a lot of good quality companies are trading on the cheaper range, mostly because the quality factor did not work in 2022 with the adjustment in rates, and a lot of people through that rotation just bought a little bit more cyclical industries and sectors. So energy did quite well, industrials did quite well, and so on and so forth. So we are finding that we through our research, that we find like attractively priced companies in the sectors that did the worst in 2022. So communications, some discretionary, not all discretionary, and tech. So we do like those sectors on a 2023 basis and beyond, mostly because if you were to assume that a company has a competitive advantage and it's able to maintain that competitive advantage and the so-called moat around their business, we have found that good quality growth companies are able to maintain that mode. So they are able to maintain their margins and they're able to grow in a steady clip, which makes them attractive in an environment of volatility. So we like growth sectors. I would say, since the fourth quarter and coming into up until today, and we probably is going to continue a little bit more. I have found that there's a short-term uptrend on valuations for cyclicals. So materials, industrials, and to extent some of the energy plays are actually getting a little bit rich for my blood. And this is, I guess, on the margins. It's not, I mean, I'm talking about like they have shoot up and they're super expensive, but they're getting a little bit more closer to the fair valuation that we have for them. So I think those sectors should, going forward, maybe underperform relatively to the market and to the other sectors that I mentioned before.
All right, thanks, Pete. And actually, another one just came in that's kind of related to that, if you want to take that one as well. The other question that came in is, given the idea that earnings will drive stock prices back to fundamentals, what is the strategy to take advantage of potentially higher for longer across both inflation and interest rates?
So higher for longer means that, for me, right, that if you assume that a company's price or market valuation is just the projected cash flows that you're going to receive as an owner of the business discounted to a present rate, to a present value via a discount rate, well, you adjust that discount rate to the new reality of higher rates, right? So like if you say to them, well, my risk-free now is going to be 3%, and my equity risk premium, I'm going to tack on another 4 or 5%, then your discount rate is going to be 8%, right? So you're going to say, well, my future cash flow to present value divided by 8%, that's what it represents. So in our models, higher for longer means that our discount rate or our perceived equity risk premium, so what we need to get back to be satisfied with that investment, is a little bit higher. Additionally, when you are making assumptions on growth and on margins and just the financial statements, how would they look in the next 5 to 6 years? Well, higher for longer means that, if there's a heavily indebted company, they're going to have to eventually roll that debt, right? So what is going to be the debt burden that they're going to have when they roll over that debt? Additionally, if something, let's say there's a company that's levered to a economic sensitive sector, let's say housing, right? Well, if you assume that higher rates means higher mortgage rates, which will have an impact on housing prices or new construction and so on and so forth, you have to adjust your potential revenue growth for that I guess decrease in business activity, because the higher rates would mean people would just be less willing to move if you were just selling your existing house, because guess what, you locked in your rate for 30 years at 2.5% or 3%, and all of a sudden if you were to move and get a new mortgage, it's a 5 and a 6, right? That's almost double your mortgage rate that you have to pay. So higher for longer means you adjust your risk, so what you're willing, so you discount things at higher rates, so you are the hurdle for something to be undervalued is actually higher, so I want a higher return for my risk, and you adjust your revenue growth in industries that are actually sensitive to higher interest rates.
Gotcha. All right, thank you, Pete. This might be a good question for Jeff. Should we be concerned with the effect of higher interest rates on our government debt?
Yeah, very good question. At the end of the day, yes. It consumes more of the government resources. And probably the bigger question there is, how large are the debt and deficits that higher interest rates end up impacting it? One thing Tim mentioned earlier, and we've talked about a few times, is that more normalized interest rates are healthy for the economy and the markets in pricing risks and capital allocation. Holding interest rates at zero or near zero and effectively monetizing the debt over time creates lots of distortions and isn't necessarily the most healthy thing for the economy and markets. But the reality is that debt does need to be financed and rolled over, as Pete said. So an adult conversation, I think, needs to happen with some of that. We've seen people are worried, is there a cliff event or something? I'm not sure about that. If you look at the interest expense, that kind of thing, relative to GDP, it's clearly moving up. It's not at stressed or extreme levels. The debt, a lot of it is termed out for longer maturities, so this doesn't happen. The Fed hikes are very rapid, but it takes time for that to filter through to the Treasury issuance and debt there. So it's one of those long-term concerns. I don't know that it's a 2023 high concern, but I think give me and a lot of other people more comfort if DC and politicians were to address some of the fiscal imbalances that we have.
All right, thank you, Jeff. Let's see, another question we got, going back to some of the topics Pete was talking about. The next question is, can we break down Pete's comment about the energy sector? Given how the sector is so large and driven by different factors, but generally higher energy prices, higher for longer, would be beneficial to most, but unevenly. Seems like, for example, the natural gas sector of energy will do well in almost any scenario, given what is happening in Europe and the need for a transition fuel that is relatively clean and in ready supply here in the US.
So the higher and longer, in my mind, was more related to interest rates, right? Not so much for inflation, but mostly interest rates. So the Fed raises a couple more times, and until we see the inflation, coming down according to their measurements, they're going to keep their Fed fund at 5%, and that is the higher for longer. So we have been wrong about inflation for the past 2 years, so I'm not going to pretend to know what inflation is going to be in the next year or in the next couple of years. Again, if you were to separate it and say, well, you have goods inflation and you have services inflation, and the service inflation is sticky and the goods inflation is more or less the cure for high prices is higher inflation is higher prices. I would say that the goods inflation is going to kind of roll over, go with the demand if demand decreases, but the service inflation is a correlation to wage growth is pretty high. So as long as if we see wage growth continue to move up, I would assume the service inflation will move up as well. So from an energy perspective, we have underinvested, right? Let's set the parameters, right? So we're in an environment where we have underinvested. Some of it was just driven by the green energy, ESG, and so on and so forth. So people are just less willing to invest in a business that they feel that are going to, it's going to be threatened by regulation and so on and so forth. And some of it was, the underinvestment was because at least for the US energy market, we went through such a boom and in the early 2010s that in a way, any project was a good project. So we kind of burned a lot of cash doing that. So a lot of financial institutions were just not willing to, provide financing to actually, drill more wells or build more infrastructure and so on and so forth. So if you just take that and say, well, the demand is constant and I have a challenged supply, yes, you're going to have a higher energy prices, right? But we don't really know what's going to happen to demand, right? And you can make two pretty good cases on like what demand is going to go higher or demand is going to go lower, right? The higher demand is that as long as the third world economies move to become more developed, their needs change from cheaper fuel to higher, more expensive fuel, right? So think about people needing cars instead of actually just walking to school and so on and so forth. So the demand is going to stay higher or move higher, or it can actually move lower that, the demographics in the developed nation is not actually favorable to higher prices because, the formation of households is actually lower, which means by association, the prices for things will have to drop and energy is going to have to come down as well. So supply constraint, we don't really know what the demand is going to be. It can be higher, it can be lower. So when we are pricing energy companies and natural gas companies, we're going through the exercise of making predictions of where the future is going to be and take it like a weighted average, probability average of where this is going to be. So for us, every energy from Chevron to a smaller E&P shop, we say, well, let's say oil is slightly lower than what it is right now. So let's say it's trading at 70 or 75 WTI. What does that mean for their production? What does that mean for their cash flow and so on and so forth? We get a projected value, we discount it to higher rates to today and say, well, is this company overvalued, undervalued? Currently, we found that a lot of big oil integrated companies like Chevron and so on and so forth are not necessarily cheap, are somewhat fair value-ish. We do find that the oil services sector is actually trading in a more undervalued valuations, and that's where we tend to focus currently. So it's, again, it's within the pockets. Like I said, the energy space is trading in the fair value range. Again, it's within the pockets of, well, what does it do? Is it just a pure play in natural gas, or is it just a oil servicing unit, and so on and so forth? So if you have more examples, I will more specific examples, I'll be happy to talk about them. And we can discuss that further.
All right, thank you, Pete. The next question here, this might be good for Tim or Jon. The question is, what are the things you're looking for to feel more confident in the direction of the market?
I'm happy to jump in on that one. I would say, the one of the main ones that I look at as an options trader is obviously volatility. So a normalization of volatility across asset classes would be a positive development. We have made progress on that in the last couple of months. So that's a positive signal. I talked in my presentation about the leading indicators. There's many different ones. Some are survey-based, some are market-based. And, there is no perfect crystal ball, right? No one has a crystal ball that accurately tells you the future. What you can do is you can get a sense of where things are and the rate and direction of change, which, the term nowcast is often used. So you're not predicting the future, you're more nowcasting what's going on right now. What's the way we're headed and what's the pace at which we're heading there? And, if you are using one metric, you are going to make a lot of mistakes. But if you bring in as much data as you can and get a more holistic picture, and it doesn't have to be a complicated AI model, but just very simple linear combinations of things, the more data that you can bring in, the greater the confidence that you can have in your nowcast.
Yeah, the one thing that I would add to that is, one thing to look for to kind of give you confidence that the market is maybe strengthening or is looking at recovery is when the market starts to react to good news in a positive way. We've been several quarters where, because the market is so focused on interest rates and so terrified of rising interest rates, that good news is seen as bad news, because good news means they'll keep rates high, and that's bad for markets. Whereas bad news is great, because bad news means that the interest rates will start to fall. That's more short-term trading as the market is trying to figure out which path to take forward, as we have these competing interests of we want growth to happen, but that means that interest rates will stay higher. And I think the sign that we're in a better, healthier, more, and be more confident of market movements is when good news is reacted to in a good way. And you see the strength of the economic news coming in saying, okay, that's good news. That means maybe we're not going to go into recession, or maybe the recession will be lighter, rather than, oh boy, that's bad. That'd be what I would look for. Let's let bad news have bad reactions and good news have good reactions. That will tell us the market's, I think, back on a healthier trajectory.
All right, thank you guys. Looks like we just have one last question here. I think would be good for Jeff, and then we can probably wrap up. So the last question we have is, I think you touched a little bit on this earlier in your market discussion on interest rates, but question here is, where do you think yields are going from here?
That's a great question. Yeah, I did talk a little bit. We'll talk a little more about it. One thing we've talked about a little bit internally is there's kind of a tale of two yield curves, but then also, we've got maybe a couple different time horizons here this year. And, kind of the shorter maturity, which is driven more by the Fed, longer maturity yields, which are driven more by economic growth and inflation outlooks, and not only U.S. but domestic as well. So, yeah, on the shorter end, tying that into the Fed, I do think at this point, Jon mentioned, I think a few of us did, the market's pricing some cuts from the Fed toward the end of the year. I think a lot will have to change economically for that to likely happen. So I think short-term yields are a bit underpriced here, or yields are a bit too low. Then kind of on the time horizon component, as we do get into later in the year, if as Fed tightening does kind of take hold, slow things down, that ought to weigh on yields. And I do think, the Fed is going to be fighting it some, because they want to try to hold and make sure that the inflation is, coming down toward their 2% target. It likely, when they change policy, it won't be at 2%, but it's going to be, they're going to have a higher conviction that it's moving that way. So, with a slowing economy, that is typically supportive of market yields, rates, and we could see them move somewhat lower. Again, like in longer term, it's a global thing, and so there's a lot of effects there. But you have had global central banks tightening, and I mean, even Japan is starting to join into to the discussion of possibly adjusting their policy some. So I do, again, as the year moves on, that gets me a little more constructive to see yields. I think longer type yields move a little quicker than shorter yields, because they're going to be pricing more to what the Fed's actually doing.
Gotcha. Makes sense. Thank you, Jeff. And actually, one more question came in while you're giving your last answer, kind of related to what you were talking about. And so just to wrap up here, this last question is related to interest rates. Jeff, what is your view on spreads widening for corporates and high yield, and when should we think about entering those markets?
Yeah. So, spreads did widen somewhat last year. They tightened a pretty good amount in the fourth quarter, kind of along with the equity rally. And I do think that if we do move into a softer economic path here, say it's a mild recession, what have you, that corporate spreads should widen some. I think at this point they're kind of maybe average-ish for kind of their long-term averages. So typically you would see them move somewhat wider. In investment grade, where we're focused, probably in a typical recession, I could see them moving 50 to 100 basis points wider across broad corporate type levels. And high yield, we're not as active in that particular market, but I think you would see those a lot of times. I read a lot of research lately. Typical recession, high yield spreads would probably hit like 800. So I think right now they're around 500, give or take, maybe upper fours. So from a pure corporate standpoint, do see some widening risk, and at this point, if someone's looking to actively add there, you probably want to maybe hold off a little bit.
Gotcha. All right, thank you, Jeff. Well, we are about 15 minutes over time, and it looks like that was the last question to be sent in. So I think we'll go ahead and look to wrap this up. But thank you to all the panelists for participating in the market discussion, and thank you to the clients and everyone else for jumping on the call and submitting questions. If there are any questions we did not get to today, let us know and we can reach back out to you with communication pieces on that. But thank you guys for participating in the call, and have a great rest of the day.
Thanks, everyone.